Welcome to TMS Insights. It's the middle of reporting season, which brings Ben and I together for one of two reporting updates. And let's get into them, Ben. We no need to muck around. It's busy out there and busy in here. And there's some really good results overall, I think, to start the reporting season. When we say that, from the second week of August, it gets pretty hectic and there's a lot of reports flying around at the moment. But just at a high level, Ben, better is what I'm feeling, and better than what we were thinking, and expectations were okay but not that high.
I think from a market point of view, look, there's most companies are still yet to report, so we'll get a better sense of it probably going into the end of this week. But I think particularly for some of our core holdings, we've liked a lot of what we've heard, and the market, the share price movements, I think, feel more rational. Everyone sort of caught out, we're going to get this crazy volatility again, which seems to happen every year. But it's actually felt more muted this time, and it feels like the reactions are a bit more rational.
And this is really important because there's so much noise around markets all the time. There's noise in the world we live in. But we're looking at black ink here. These are the reports. This is what the companies are actually doing. So that's why we do spend time to give you these updates, because this is what matters, not the noise. So let's get right into it. And I'm going to talk about one of the biggest ones. It's been a stock of real focus in the last few years, an Australian darling, but it had fallen from grace in recent times, CSL. So now let's just play this out. This is a stock that hit circa $350 a couple of years ago and went as low over last year as $90. But its result, it was moving up a little bit before it, Ben, but it's taken a real liking the market to that result. Let's just unpack the whole CSL story.
So look, I think let's start with the result. The core business of CSL is Behring, and Gordon Naylor's gone back into CSL. In Gordon we trust, who was very well regarded. And he opened the earnings call by saying CSL is back, and we're back for business. And it was a messy result in that there was a lot of impairments and non-cash write-downs, etc. So the headlines didn't look great. But the thing that the market has really cottoned onto is the growth that's come out of Behring, and it accelerated into the second half of the year, and I think there was the concern that Behring was broken, which is why we saw the stocks trade at such a low multiple. It's not that the business is completely humming again. 5.4, which in hindsight was a disaster.
It's a clear mistake.
But it was a shocker.
And that's a dialysis business that's basically delivered way unders and is outcompeted now. But Behring was Gordon knew it very well when he was previously at CSL. The plasma business was the driver of the earnings through the noughties and the glory years. And but it's a global oligopoly, and you can lose your strength of leadership when you lose focus. And buying Vifor clearly took the eye off the Behring business. Right. And now they're back focusing on what they do well.
Yes, and in going back to what is the crown jewel of this company, and he called out a number of things that they've been doing. It feels like they're really starting to get that humming again, and you could feel the confidence in his voice on the call, and for the medium-term outlook as well. So I think the market has really liked that the stock's reacted, but it's still only trading on 18 times current year earnings, which, just to give you an idea, CSL for the last decade has traded on 38 times earnings. Now, maybe that was too high, and I don't think we'll see that again, but there's still room for multiple expansion. Because I think this year is going to be a year of growth, but not at the rate we've expected.
So mid-single-digit earnings growth?
I think so.
Possible more.
But the FY28 year, we could start to see double-digit again. And look,
And this is a study in the market. So this stock just got ripped apart through the course of the last year. CSL, who'd been buying back stock at higher levels, had bought back at modest levels in this recent sell-off. But to go from $90, and the rating, what PE must have been about 11.5 or something.
Yeah.
So
Crazy.
It's just how it's a study in the market, isn't it? About how everybody can throw the baby out with the bathwater. You can still stuff up a business like they did with Vifor and still have a great core business that you can get back into vogue and start moving ahead. And CSL, like you said, it's back in business.
Yeah, and I think the most important thing when you look back at this, and it was something we were doing a fair bit of work on over the last year, was just making sure the balance sheet was able to withstand the earnings pressure that had come through.
And to play that out, Ben, if it hadn't been right, explain to people what goes
Yeah, so
wrong
what we so often see, and it's a killer, is a company goes into a downgrade cycle, the earnings don't meet expectations, and if it's carrying too much debt, and maybe that debt wasn't too much versus the start of that downward trajectory, but it is when you get to a point.
On the asset revaluation.
Yes, and they're looking at covenants, etc., and they're thinking, okay, we're going to have to raise capital. The worst thing that can happen is that you do a capital raising when the stock was, say, at 110, 120, but you got to raise at 90 or 95.
Dilute the equity.
The earnings per share the profit starts to recover, but with so many more shares on issue, the earnings per share doesn't.
Yes.
And that will mean that the recovery out of the earnings downgrade cycle will be so much slower. Now, because CSL's balance sheet was pretty pristine going into this downgrade cycle, they actually bought back $1.1 billion of shares last financial year.
The other way.
And they'll do $1 billion this financial year.
So they've created value in that sell-off for shareholders.
That's why balance sheet is the most important thing.
Always matters, yeah. And it's why stock analysis matters and what we do. And this is a test case for just getting to know a business, being in touch with them, long-term, followers, knowing some of the people behind it and understanding the nature of a business. So, that story alone provides so much. So it's great to see CSL's recovery. It's really rewarding. Let's just spend a bit of time on that space though too.
Yeah.
Cochlear, ResMed were part of a sector which had a horrible 2025.
It's interesting. If you look at the ASX 200 last financial year, the healthcare sector fell 37%. It was also negative the year before that. I think it was like minus 20, 25. So 2 years running, healthcare, which is, if you looked over the last 20 years,
it's been a great sector.
Easily the best performing sector. But the last couple of years, the worst performing sector.
And Cochlear had its own problems. ResMed not so much.
No, ResMed's had no problems, but the share price has been a problem.
So let's talk about the result for ResMed, and then we'll talk about Cochlear. ResMed's result again, and most of those results in recent times have been lot to like about them, but they're still lagging. Like compared to CSL, Cochlear we'll talk about, has gone up as well. ResMed still looks undervalued.
ResMed's the buy of the space, I think now, because you can almost set your watch by how consistent this business continues to grow its profits. It's got net cash on the balance sheet. It's pursuing on-market buybacks. It's trading on a much lower earnings multiple than it has historically. And so the reason the stock came off a bit recently on their fourth quarter result was because they gave quite conservative guidance versus analyst expectations for the current year. But we've owned this business long enough to know that they are always conservative when they give guidance, and then they'll beat.
And market reactions don't always make a lot of sense after results with quarterly earnings.
So that's now one I think could re-rate. And I think, if you look, as of July 1, Jez, best performing sector in the ASX 200, healthcare. So we're seeing it revert.
And just briefly, Cochlear, again, they've had some issues, but their result was well received as well, and they've improved. So.
Not as bad as expected, I think.
Not as bad as expected.
Yeah.
Let's talk about a stock that's been, again, a favourite of ours. It's had a tough year, but a good result, and did lift on the back of it, REA Group.
Yeah.
Always early to report. There's a narrative there, isn't there, around AI,
Massively.
About the thematics, and again, some of this is noise. This is the thing.
Absolutely. I mean, I think most people now would have heard of the term SaaSpocalypse, but
January 6th, it was this year.
It was when it started, and when Claude was launched, and the marketplaces globally have also been hit on concerns about AI disruption. Just a tidbit I give you that I've seen is on the February earnings call when REA reported, how these things work is there's a 30-minute presentation, then there's a 30-minute Q&A from all the analysts. And you normally get about 15 probably questions.
Yeah.
In February, every single question, and I think we spoke about this in February on the Insights, was AI.
Yeah.
Every single one. I couldn't believe it.
Yeah.
This August earnings call, there wasn't one question about AI. So it was all about market conditions, depth.
Yeah. And that narrative's played out a bit too, because the housing market's slow. So, but people have got their heads around this AI thing. And then look, our piece is it's going to matter, but at a time frame that's shouldn't be worrying the markets here and now.
I mean, there's still Cameron McIntyre, the CEO of REA, I think he almost did this to placate the market. They're providing the data that they're getting from ChatGPT if someone's searching for a residence, and they're doing it through chat and it's sending them to REA.
Yeah.
He said it's held
disintermediating
under 1%.
at all. It's totally,
And I just say, like, the housing market is in a state of flux in this country. I don't think it's as bad as the media is portraying.
It's noise.
But what I will tell you is this financial year, REA is projected to grow its profits 20% in one of the toughest housing market conditions we've seen. So that's a great business.
And of course, it got derated, so its multiples, which were lofty at one point, are not.
Much more attractive.
So it's looking good. Parlaying that into car sales and then Seek,
Yep.
there's a good story in car sales. Cameron McIntyre, of course, is ex-car sales.
Yep.
So it's pretty interesting how he's moved there.
Yeah.
But they look good with their international businesses.
Yeah.
They're fine. Again, there's some of the same AI thematics that knock them around.
Definitely.
They were pretty high a year and a half ago.
All three businesses have had this AI derate, despite the businesses continuing to show that it's not having an impact on the business.
Yep.
We've seen this in America and every other market. I do think that the investors are starting to wake up and see that these businesses potentially are actually going to be accelerated by AI. Not all, but some.
Yeah,
and I think these could.
Huge opportunities of cost savings
Absolutely.
as well as growth. They all have. And
I think car sales is, of those three, the industry backdrop for them is pretty good.
I agree.
And for Seek and REA, it's not at the
more
moment.
challenging.
Yeah.
See, longer term for REA. Let's talk Seek briefly. The challenge is a bit here and there now.
The challenge with Seek is not anything other than the employment market. And so Seek gave a guidance that was under market. The result was good. But the reason it was under market is because they're using a much more conservative assumption of what the job ad churn on their website will be. And that's because they're taking a more conservative view on the employment picture this year. Now, no one knows how this will ultimately... The employment market's been stronger than everyone thought it would be.
Yeah.
Globally. It's not just here. So
they've been let down on their ventures businesses, though. There's no doubt about that. They were always opportunities, but they haven't materialised, and that's an issue for them. Let's keep moving. Broken Hill Proprietary, BHP. What a company.
Old school.
Nice old school company. But very much, again, great to see the base metals businesses. Iron ore was a good contributor. Large jump on the back of another very good result from BHP.
And copper. You know, I didn't listen to this earnings call, but I read the analyst notes.
Yep.
And normally a new CEO coming in, normally pretty vanilla, finding his feet. He was beating the table about the $45 billion in copper expansion opportunities the company has, saying he wants to run them concurrently. Copper's now 54% of EBIT for BHP. Great dividend beat, 99 US cents. And it was about 20% higher than the market expected. The result was stronger than expected. Like the margins, like 63% in copper. This company is morphing, and in the next 5 to 10 years, it's going to change dramatically because it's going to be a more global. A lot of these mines are offshore in South America and Olympic Dam. He's talking about the expansion of, but the copper component is going to significantly increase.
Yeah, and Jansen Stage 1's nearly complete.
And starting to produce, I think. So
there's some upside in that.
Yeah.
Phosphate. So that's great. Getting around a couple of other ones quickly. Pinnacle. Great result.
Great result. So, that's a bit of a dark horse. It doesn't get spoken about a lot, but I think I listened into that one, and Ian McCown, some might remember, he spoke at our 20-year function in Sydney. I what he highlighted was the extremely good run rate that was coming out of the last quarter of the financial year in terms of the fund flows. And they've just been really good at bringing in affiliates, or we call them affiliates, they call them affiliates, fund managers that they take stakes in.
Boutique
that
asset
their distribution team then brings to us.
Provide everything but the asset management.
Exactly. And some really great groups that infill holes that advisors like us are looking to find solutions for. And they're in the hundreds of billions of fund now. It's been an incredible success story. It feels like the market hasn't given it the credit it's
No, and
owed.
there's again some stories about Metrics, the private credit business.
Yep.
But there's some great stories. Really,
Metrics drag.
There's a drag, and there's a story there, but it's a piece of the puzzle which is diluting over time as they're growing. And again, they're quite a cyclical stock.
Yep.
As that industry is. Keep moving on. Pro Medicus, a software health related stock, which has had an unbelievable performance, but a tough year too. So earnings are growing, and
it's been caught up in the SaaSpocalypse.
Yeah, basically.
And I listened to this one because I thought, it's the first proper software company to report, and the result was stronger than expectations. But I think their founder Sam Hubert gave a great presentation on how AI is dramatically accelerating the business rather than going to hurt it. And I think we're going to hear more of this from other software companies that are yet to report. But the thing he called out was that the contract pipeline was the strongest in the company's history. They've already had some pretty big contract wins in the second half, which are yet to take. So they're going to have a great year next year.
And the network effect they get that you see once they've signed a few contracts, there are usually a few more coming.
Yep. And there's new product releases. They've got a new screen for breast cancer that they've started to roll out.
Yeah.
So this is a great Australian success story. It's all going into America, and it's the biggest customers of the American hospitals, and it's definitely one to have on the list, I think.
Good one, yeah. Brad, just finally, two platform stocks clients will know.
Yep.
Netwealth and Hub. They've both reported growing businesses rapidly.
Yeah.
Higher multiples sometimes, so you can see sell-offs and things like that. Just that space, talking on the back of the Pinnacle comments.
Yeah. I think ones to also put on the list because they have been quite volatile.
They're volatile, so there's
opportunities. Because the multiples are quite high.
That's right. But there's earnings growth.
The businesses are growing.
And they've got operational leverage.
Incredibly well. Yeah. And it's not just earnings growth, it's the earnings stickiness, I think, is underappreciated.
Good sector to look at, I think.
Yeah. And this is another kind of two stocks that got caught up in this AI freak out last financial year. That I really can't see. Like the case for disruption there is even harder to see. So, but they get thrown into the bucket of, growth stocks / SaaSpocalypse, and we saw some meaningful PED ratings. So they could be good to look at. Yeah, great stuff, mate. That's terrific to get you all the updates of the first part of reporting season. We'll have another one later in August.